uptrend. An uptrend occurs when the price consistently moves up or higher, forming higher highs and higher lows. This shows that buyers are in control, and it's a sign of bullish momentum. Traders often look for pullbacks within an uptrend to enter the market. A downtrend is the opposite of an uptrend. Here, the price is making lower highs and lower lows, indicating bearish momentum. Traders often look for opportunities to short or sell during a downtrend. Support and resistance. Support is a price level where demand tends to prevent the price from falling further. Here, price falls, then shoots back up quickly, creating a support zone. Now, as price falls back into that zone, those same buyers start to buy in that zone, pushing price back up. Resistance is a level where supply prevents the price from rising. Here we see something like our support zone from earlier, but now price is initially pushing up and then sharply pulls down. We mark this a resistance zone. Now, as price gradually makes its way up again, those same sellers that sold off originally start to sell again, pulling price back down. Identifying these support and resistance zones helps traders plan entries and exits. Trend line. A trend line is a tool that helps traders identify the direction and the strength of a trend. During an uptrend, for example, when price makes those higher highs and higher lows, there's often a straight line you can use to connect all the points with. This is your trend line. The more touch points, the stronger the trend is. Once price pulls back to the line, there's a good chance it'll bounce back off. Volume. Volume shows the investor the number of shares or contracts traded in the given time interval. This is important because it shows at which levels people are the most interested in. Higher volume can indicate higher interest and higher volatility, while lower volume indicates a lack of interest, which can lead to lower volatility. Consolidation. Consolidation is when price moves sideways in what kind of looks like a box. This indicates that the market is currently indecisive, and there are close to an equal number of buyers and sellers balancing each other out. Typically, during consolidation, volume tends to decrease. However, consolidation often precedes a breakout, making it a critical zone to watch. Reversal. A reversal is when the market changes direction from an uptrend to a downtrend, or vice versa. Identifying reversals early can help traders capitalize on the new trend. Here, we see an uptrend making higher highs and higher lows, but now we see price start to slow down a little, then it reverses, becoming a downtrend. Breakout. A breakout occurs when price moves beyond a key support or resistance level. Breakouts often indicate the start of a new trend and are usually accompanied by high volume. Here we see a price in this range, consistently bouncing off support and resistance. But here, price seems to break out of this range, shooting through supply. Also, notice this is accompanied by high volume. Head and shoulders. A head and shoulders is a common beginner chart pattern that traders use to predict a future reversal. The idea is that when price is in an uptrend and it pulls back, it creates the first shoulder or the beginning of the neckline. Then price continues slightly higher past that initial pullback, followed by a new pullback. This is the head and the highest point of the pattern. Lastly, price pulls back, staying level with the first shoulder, creating the third and final shoulder. Then, on that final pullback, price continues lower. RSI. RSI, or the Relative Strength Index, is a momentum oscillator/indicator that tracks the relative strength and relative weakness of the security at the given time. The indicator ranges from 0 to 100, and rule of thumb is when RSI is above 70, the security is considered overbought, and when it's below 30, it's considered oversold. In this case, we see here that price is trending up, but our RSI is telling us that it's overbought, and turns out we see price start to drop. MACD. The MACD, or Moving Average Convergence Divergence, is a trend-following indicator that shows the relationship between two moving averages. When the MACD line crosses above the signal line, it's a bullish signal. When it crosses below, it's bearish. Here, we see price at this low, but the MACD is starting to cross over, hinting at a reversal. And like we thought, price reverses to the upside. Fibonacci retracement. The Fibonacci retracement is a tool traders use to identify a potential level to where price continues a trend. Based on the Fibonacci numbers, you identify a swing low and swing high on the trend, then wait for a pullback. The 38.2% and 50% levels are the most ideal. Once price pulls back to these levels, you can see a bounce right off, continuing the trend. Market structure. Market structure refers to both a break of structure and a change of character. A break of structure happens during an uptrend, when price is making higher highs and higher lows. Every time price goes higher than the higher high, it creates a break of structure. A change of character happens when price breaks the previous structure, signaling a reversal. Fair value gap. A fair value gap represents an imbalance in the market that's created by a sharp move either up or down. Price moved so fast that some orders didn't fill fast enough and are waiting to get filled. Price will naturally gravitate towards the imbalance, fills those orders, then continues the trend. Liquidity sweep. A liquidity sweep is a method used by the market to fuel a desired move. For example, here, the market wants to move lower but just doesn't have the power to do it. So what may happen is the market can move a bit higher, where many people have their stop losses, kick them all out of their trades, and with that fresh wave of liquidity, the market can then move lower. Did I miss any other strategies? If I did, please let me know in the comment section. If you learned something today, please drop a like and subscribe. It only takes 3 seconds but does so much for me. Thank you, and I'll see you in the next one.